Uh, Hi, everybody. Good morning or good afternoon or good evening. It's Barry Parker here, and I'd like to welcome you to another interview for Capital Link's Trending News podcast series. So today we have with us Stamatis Tsantanis, who's the CEO of United Maritime. Company trades on NASDAQ Capital Market, and the symbol is USEA. So United Maritime is an international shipping company specializing in worldwide shipping. At present, it operates one LR tanker, two Capesize bulk carriers, and one Panamax bulk carrier. There are three other vessels in the pipeline, so correct me if I'm wrong. I think there's three that are in the pipeline now. So you have one additional Capesize on the way, so you're gonna, when your acquisitions are all done, you're going to have 7 vessels in the fleet, which will be the 1 LR that you have, 3 Capesize, 2 Kamsarmaxes, and one Panamax.
That's correct.
So I hope I got that right. And the total dead weight of all the vessels, it's just shy of 900,000 dead weight. It's 870 something thousand. So United Maritime just recently reported the financial results for the fourth quarter, ended December 31st of last year, 2022, and also from the period of operations. You started it's a spinoff July 6th, 2022. So it was operations for the period July 6th through the end of December. And you also declared a quarterly dividend of 7.5 cents a share. So I have a lengthy list of questions for Stamatis. We'll try to go quickly, but we'll talk about company's achievements and performance since the spinoff, and then the objectives, and I think very importantly, the strategy going forward. So let's get right into it. So in July, United Maritime was spun off from Synergy Maritime Holdings as an independent company, and you started trading on the NASDAQ. And like I said, that was first week of July. So what was, if you could talk, Stamatis, what was the rationale behind the spinoff?
Well, first of all, good morning, good afternoon, and good evening, depending on where you are. It's a great honor to be on this webcast right now, and but it's always good to see you. I wish we could have been presenting this in person, but I guess that the current circumstances do not allow it. I hope we will do that in the future. So thank you for hosting me, and thank you for all your questions. I will start by saying that United Maritime was spun out of Synergy, and we took this decision because Synergy has always been a pure play Capesize owner of ships. So we decided to build upon the relationships with the major global charters as far as Synergy is concerned. However, during the last 5 or 10 years, we have been presenting with a number of amazing acquisition opportunities and deals that we were not able to perform due to the fact that Synergy was specialized on the Capesize segment. So we decided to diversify and have the ability to offer those deals to our investors, first of all by executing them, and thereafter by being in a position to do these deals. So we started with the oldest Capesize that Synergy had at the time, because we had to start with a ship. And then we started building on that by acquiring our first fleet of tankers, which proved out to be quite well. So the purpose behind United was to diversify and create a vehicle that was going to be able to buy low, sell high, and distribute profits to the shareholders as quickly as practically possible. That was it. Okay.
Yeah. So I think I'm familiar with Synergy. Synergy, if I remember, it's all Capesizes, and some of them tend to be on longer charters. They're not all spots. So that's instant difference. And I think you've explained the objective and the strategy, but I guess what's on my mind are the different, the different sectors. So you're moving, you were in the tankers, you're moving back into bulk carriers. Are you going to look at opportunities across other sectors, or are you going to stay with one sector?
Well, the answer is that we are sector agnostic. As long as we believe that it's something that can potentially be beneficial to our shareholders, and as long as it's a liquid asset, I mean, that means it's not a highly specialized, and we can move in and get out as quickly as possible, then the answer is yes, we would be looking into other opportunities, what we deem to be beneficial for our shareholders from time to time. So as long as it's a mainstream asset with high liquidity, entering and selling, and as long as the asset fulfills our criteria, meaning that it's a good quality of ship, it's going to be tradable and commercially acceptable in the next few years given the regulations, then the answer is that we're sector agnostic on a mainstream basis. As simple as that.
Okay. You talked a little bit about the strategy. So I guess what I'm curious, and I want to focus on whether you're going to continue. You did extremely well with the tankers. I think just to review what you did. I mean, it's phenomenal. So during your first 6 months, you bought. So again, let me get this right. So I think there were two Aframax crude tankers. There were 2 LR tankers, and you sold 3 of the vessels. So I think you have 1 LR still in the fleet. And you mentioned in your earnings announcement, it was a return on equity of something like, it was over 350%, something like that. Again, within 6 months. So, it's phenomenal, but is that the kind of thing you're going to be looking to do in the future?
Well, obviously, I cannot guarantee making a 350% return on equity all the way into the future. That's something which, in my opinion, is quite unattainable. But we will do our best, given the fact that we have good sources of tonnage. I don't think that we will be in a position to take advantage of cycles like that happen once or twice or 3 times maybe in the history of a business cycle. So I don't think that's attainable into the future, but we're going to do our best to deliver very strong returns to our shareholders in the future. So I don't know if it's going to be 350%, but surely we'll do our best to deliver as high a return as possible.
Well, never say never, because as we're recording this, this is the beginning of March, and I think the Baltic Dry Index has doubled like in the past couple of weeks there, and you're getting heavily into the dry bulk. So I don't know. You just announced the second phase of your investment. So as we said, you're moving into dry bulk. So 5 dry bulk ships, 2 Capesize, 2 Kamsarmaxes, and the 1 Panamax. So following this transaction, when these all close, you're going to have 7 vessels. 6 of them are going to be dry bulkers. Mm-hmm. So what is it? I'm marveling how at the timing, but what is it that caused you to look at the dry bulk at this point in time?
Well, we feel that first of all, among the 3 main sectors in shipping, which is dry bulk, tankers, and containers, containers have had a very good run in the previous years. They went all the way up, and then they started correcting again. We feel that there's a long way to go on the container segment on the downside, and we're also a little bit concerned with the new building order book. So, we're not so much looking into the containers as a highly liquid in and out investment proposition for our shareholders. Tankers, we took advantage of the cycle to the best of our capacity. Not only we identified the right ships at the right time, we got in and took delivery, and we sold them very quickly. We still feel that tankers have a long way to go to deliver returns to the shareholders. We felt that by selling the ships, we have and captured a big percentage of the cash flow that the vessels would be making over the next few years. So we kind of discounted that a bit early and got out. And we feel that we are in the beginning of a very strong super cycle, hopefully, for the dry bulk. So we feel that right now the values are still not at the absolute bottom, but surely they have corrected by about 25% since the recent highs over the last couple of years, and they can continue to go up substantially over the next few years. So we feel that it's the right time to enter into the dry bulk right now. For us, it's not only a matter of value, but also the selection of assets. Even though it's a highly liquid segment, there are not so many quality candidates for us that will fill our criteria, meaning the age of the ship and the quality of the ship. And don't forget that you have upcoming environmental regulations, so we have to make sure that the ships will be commercially acceptable in the future. So we're doing the best that we can to identify and proceed with good purchases. We have done so, and we expect that the dry bulk market will produce good returns for the shareholders in the next few years.
Okay, you mentioned environmental considerations. So, one question is the age of your fleet. I think the average age of your fleet is around 14 years, 14 and a half years. So how does that stack up against what everybody else is doing in a business that's increasingly environmentally conscious?
Well, true, but at the end of the day, age is not necessarily a recipe for success or a disaster in shipping. I mean, the best returns that we were able to produce to our shareholders were made by two vessels that were built in 2006 and one vessel that was built in 2008. So if you take out the remaining 2008 ship that we have, the fleet average age is around 12, which in my opinion is quite acceptable, or 11, whatever that is. So we feel that if the market runs, and for the purposes of United as a high liquid and high return platform for our investors, older assets may produce greater returns given the investment of capital that it entails. So overall, we're very optimistic. We don't feel that as long as you meet a certain criteria for the vessels to be tradable, it's not going to be an issue at all as far as entry point and selling point is concerned. So we feel very comfortable with what we have. They're highly quality Japanese-built assets in the vast majority. So we don't really see any issue with the age.
Okay. Okay. You mentioned that you want to reward the shareholders and implement shareholder-friendly measures. So I mentioned just the dividend, but I wonder if you could just talk us through some of the other initiatives that you have in that context.
First of all, what differentiates United from a number of other companies and notably many other spin-offs is the fact that we have a highly disciplined share count. So with the exception of our first offering that we did in the summer, that was last July, that was our launching offering, which was done at $3.25 per share, we decided not to proceed with additional offerings that would unnecessarily dilute our shareholders. So for us, a disciplined share count is something very, very important. So we raised capital at $3.25, but since the stock price initially did not perform as we had expected, we used $6 million of our capital to buy back approximately 25% of our share count. So we issued shares at $3.25 and we bought them back at an average of $1.80, which we feel that was a very active and successful stock count management. So for us, having a disciplined share count and being in a position to distribute profits on a per share basis, that's very impressive. Please have in mind that on a dollars per share, we did the P&L of almost $5 per share of a net income, and that's very impressive. And it's not only because we made a ton of money from the ships, but most importantly because we have a very limited and disciplined share count, and we will continue being disciplined on that front. So we issued shares at 3.25. We bought them back at 180, or we bought a portion of them back at 180. Then we paid a dividend, which we feel that has been almost a third of the share value at the time. So we have already delivered a very strong return to our shareholders. And now we're initiating a new dividend policy. So overall, buying back shares, paying a dividend, and eliminating dilutionary effects like convertible preferreds and all that is what we believe to be a good overall good shareholder package for our investors. That's how it is.
Okay, that requires some cash. So the question is, how do you balance that versus reinvesting, those funds, buying ships? How do you balance that?
That's a great question, Barry. I mean, we made so much money on United that we had plenty of cash to do all of the above. Not only we paid a dividend, we also bought back a significant amount of shares, but most importantly, we regrew our fleet. We actually grew it to a larger scale than we had before. We started with 1 + 4 ships, that was 5, and now we're growing to 7. So, the return that we were able to deliver not only was super shareholder friendly by distributing cash, buying back shares, but also we regrew the fleet to almost 900,000 deadweight tons. And just to put things into perspective, if that was converted into, let's say, Ultramaxes, that would be around 14 Ultramaxes. It's just that we have bigger ships that play a role. So we regrew our fleet to 900,000, which for a startup that has not even completed a year, just by nothing, it's already a very good package of return and the fleet base altogether.
Okay, well, let's just talk about normal things. Just so you initiated the 7.5 cents per share dividend. So is your intention to maintain that, to do that every quarter, and would that come out of regular fleet operations?
Yes, we feel very comfortable with the way that we have announced our dividend policy, and that's a regular quarterly dividend. And we think that we can even grow our fleet further by continuing to pay the dividend, of course, that goes without saying. Please have in mind that all these things that we have done was not only without dilution, but also with a big accretion to our shareholders altogether. So we feel comfortable about the distribution of the dividends into the future. We feel comfortable that we can continue buying some additional assets and growing our fleet further. So we're very comfortable with that. If we don't find additional acquisition opportunities, then we might as well pay bigger dividend. We'll see about that. But the intention for now is to have some sort of a regular payment so that people can at least rely on a 10% return at a minimum.
Sure. When growth opportunities do come up, like other vessels, what are you thinking about in terms of financing that? How might you do that?
Well, first of all, we have the traditional sources of debt that we have access to. We have been very successful, and we have a very good and diversified sourcing of bank debt. So in the event that we come across opportunities, with the equity contribution that we can use from cash and cash equivalents, as well as some traditional bank debt, we can grow the fleet, on a very, very conservative and careful basis. Okay.
Well, let me ask you about the market cap now. It's around 26 million. So how does that contrast with the financial situation? The book value may be more, the net asset value, I haven't computed it. You're probably at a discount to the net asset value. What do you attribute that to?
I'm going to try and be very careful with, not providing any guidance, but we feel that we're at a massive discount or NAV. So if I want to give an NAV range, I would say that the NAV per share is in the region of $9 to $11 per share. But that's, again, with all the safe harbor language associated with giving such a guidance. United has been overly penalized by association, to put it this way, since all the spin-offs so far have been, overly diluting the shareholders. People think that, we fall into this category, even though we don't. We're doing completely the opposite. So once people realize that this is a company that is been rewarding the shareholders, creating constant accretion on the shareholders, and have been delivering cash back, based on successful deals, and we have a continuity and stability on that, I believe that the stock will reach its expected value little by little. I mean, you cannot change perception, overnight, but unfortunately, the perception of spin-offs is that, it's super dilutive and you're doing offerings at cents on the dollar. We're not doing that. So, once people realize that we're different and we have a quality and intention of, immediately rewarding our shareholders, I think that we will see the true value of the company little by little.
Well, you kind of got to my next question. Just, I'm wondering, is there any other way you would distinguish what you're doing versus the other spin-offs? I mean, there's been some very bad press for some of these companies with all the dilutive, you can't count all the offerings, and you're actually going the other way. Anything else that might distinguish you from some of the other spin-offs that are out there?
Well, like I said, we're doing everything that we can, which is little by little. We have repurchased shares. We don't want to repurchase too much because we want to leave significant liquidity for the stock to trade well. We want to pay the dividend as we do. We grow the fleet very carefully, and we will continue having big discipline on the share count of the company. So little by little, I think that the true value will unveil itself, and we will show a much higher stock price. That's what I think. We're doing everything we can.
Okay. Well, so let's finish up because we're kind of running out of time. But just I'll just give you a chance. Just how would you summarize United Maritime today?
Well, United Maritime is a high growth company that will continue to deliver significant returns, or at least our intention is to continue to deliver significant returns to our shareholders. We will have access to some good acquisition opportunities, and when the time comes and we feel that we have met our returns criteria, we will not get married to the asset. We will sell it and try to distribute as much as we can. So we're on a constant lookout for deals that may not necessarily entail 5-year contracts or things like that, but we'll try to deliver good returns to our shareholders as consistently as we can, and we have so far done, like you said, a remarkable job doing so, and our intention is to continue doing that into the future. It's as simple as that.
Well, it's a great it's a great story, and I wish you well with it, and I think the investors who are listening to us talking here, I hope they can participate and do well with your company. So thanks again. This is Stamatis Tsantanis, the chairman, the CEO of United Maritime. So we'll sign off here. Thank you.
Thank you, Barry. Thanks everyone for listening. Thank you.